Good morning, everyone, and welcome to the Ankerstar Wealth Morning Show. I'm your host, Allison Ankerstar, and today we'll be talking about coping with the bear market, the Fed's likely 1% rate hike, and Citigroup's earnings. But before we begin, as a reminder, this is a financial education presentation and should not be construed as personal financial advice. Full disclaimer information is available at ankerstarwealth.com. Good morning, Steve. As the near market continues on, what are the best ways to cope for the retail investor?
Hey, good morning, everyone, and welcome to our show this morning from Chugiak, Alaska, which is on the north side of Eagle River, Alaska, which is on the north side of Anchorage, Alaska, which is not quite up where Scylla is. If you remember Sarah Palin, kind of from this sort of area when she ran for president back in the day, so you can't quite see Russia from here. But it came up to Alaska for a couple days for a friend's change of command for the third wing, so pretty exciting for Jinx and his family there, and get to go to that later on today. But back to the question of the day. So a bear market rages on. What are some of the coping strategies to deal with that? So let's switch over to a different screen, and I will show you some screenshots that I thought were interesting. First of all, during a bear market, and here's the these are screenshots from my phone. Realizing right now is probably one of the toughest times we've had historically, because not only are stocks in a bear market, which you get like, okay, normally the 60-40 portfolio, proper portfolio management means when your stocks are down, your bonds would be up, right? And you should have an allocation to cash. Well, we're in a situation, and it can seem like, your advisor is challenged, right? Because everything's losing money across the board. It's like, Steve, why are you losing money? All this stuff. It's just like, but we're still losing money. It's like, well, everything's down. And there's no safety. There's no place to hide, if you will, no place to run. So you can see that when last time stocks, bonds, and cash were on a bear market was in the 70s. So everything is resetting down right now, which is the particular challenge. Now, the good news is that all is not lost. So as far as coping, just kind of knowing what's going on is one thing. And then let me get to a different screen here for the ways to view it. So is there, this is from Josh Brown, and you can kind of see his face there. He's on CNBC a lot, very charismatic kind of guy. And he has a matter of fact, point that, like, you can tell that look on his face there is kind of like, whatever. But as far as when you think about coping with your portfolio being down now with your 401k, IRAs, your taxable account, stocks are never down 3 years after a recession. So now, are we in a recession? Not quite yet officially. Maybe, I think we are, but it'll be identified here soon. But once we are officially in a recession, then stocks are never down 3 years later. So that gives you that helps you with the long-term perspective, right? Of, okay, yes, it sucks. It does. I know all the balances are down. There's no place to hide, but simply have to hold through and kind of grin and bear it during this time. Obviously, have short-term objectives you need to meet. We need to pay off some taxes, pay off, whatever it is you have to pay off. Then you got to free up cash and do it. Just grin and bear it and do it. But the rest, if you don't have to free it up or don't have to sell, you got to hold on through these downturns. All right. And then the last one I will show you is that if you are in a position to be able to buy, there's several folks out there that contact me and say, is it time to buy yet? Well, I did say that, and I said it back in around April or so, which was obviously too early. So what you want to do is, if you have money to be able to put into the market at this time, the scary time is the time to do it. The bear market is the time to buy, right? And they say bull market, bull markets make you wealthy and bear markets make you rich. It's because when the stocks are down and they're out of favor, things are really cheap. As this advisor here, James Pollard, is saying, that hosts his own a different show, he's getting 20% more out of his money because we're in a bear market, right? So a little bit of a glib comment, but if you have the ability to buy in right now and acquire more shares, which is that key to wealth building over time, then you'd want to do so. If you can't, then your last coping mechanism is to simply look away. So coping mechanism number one, educate yourself, knowing that this too shall pass. Two, know that if we do dip into a recession, stocks have never been down 3 years later. So we'll go into it, and then we'll come back out of it. And then the third one is, if you have the ability to buy more, do so. And then the last one, of course, is if you just have to look away to cope, simply look away, and better days will return sometime.
Next, the majority of analysts now think the Federal Reserve will raise rates by a full 1% at the end of July. Will this happen, and what will it do to the markets?
Allison, I do think it will happen. And I think here's the course, and I have this. I probably need to do a standalone show on exactly how this is going to play out and why why I'm excited about it, if you will. Is you have, and we talked about this since the beginning of 2022, you have the disease, which is inflation, and then you have the cure, which is the Fed, and you don't want the cure to be worse than the disease. I think it's inevitable at this point that the cure will be worse than the disease. So the disease stayed, the inflation stayed trickier and higher longer than we expected. So the Fed, who was on like a path of this level to kind of deal with it with their half-point rate. I just remember a few months ago, we're talking about half a point being a big deal, or 0.5%, excuse me, being a big deal. Well, now they've ramped that up to where they're going to, increase the medicine, if you will, to deal with inflation to make sure they kill it. What's the natural byproduct of that is, well, I think the cure will be worse than the disease because they're going to go up 1% at the end of the month here in a couple of weeks. And at that point, I really do think the Fed will overshoot the proper target. So instead of staying on a nice, easy path to inflation, they're going to be pressured or in a hurry to deal with it, meaning increasing their rate hikes to the point that we will well overshoot what we actually needed to beat inflation. Part of that's political and part of it they have to. I get that. I'm not saying I could sit in the Fed chair and stick with the 50 basis point rate hikes either, because they're just getting too much pressure for being idiots, right? So it's like, okay, but do understand that they will likely overshoot, which we've done several times in the past. Why simply react when you have the time and energy to overreact? That was kind of a leadership philosophy from the military, is they will do too much, right? What that means is we will overshoot to the upside and then immediately have to start the conversation once inflation is under control. We'll immediately start coming back to getting things back, opening the economy again or juicing the economy and dropping rate hikes. So can you believe that? We were going to spend all 2022 raising rates, and in 23, I bet you we start dropping them. We saw this in 2018 and 2019, and we dropped all the way back to zero. Do I think we do that again? I kind of hope we don't. It would be nice to stabilize in a common adult type number, like a percent or two for interest rates. But again, these are humans, and we've seen this. And even though, people will certainly, with new people in office here starting in January, for a third of them, if you will, they're going to want to start opening that economy back up. And if we do slip into recession, which I think we will, we're going to be in a hurry to get back out of that recessionary environment. So that's what I see happening with the rate hikes.
Last, Citigroup beat earnings this morning and the stock is up over 6%. Is ticker C buy, sell, or hold?
Well, I think it's it's the first real good news we've had of this particular earnings season. So when we talked, a couple weeks ago or last week, or maybe earlier this week, it's been a long week. It was earlier this week that, earnings season is really going. This is the week one of a 6-week earnings season, and it's going to set the tone. And, we really need earnings to be good to bring positivity back into the market so markets can go higher, if you will. If this was a terrible earnings week, then the market's just simply going to be stuck lower for probably, another 6 to 8 weeks, if you will. But this was a bright side. You can see the market is celebrating it this morning. Not necessarily, markets are a compilation of a million data points, right? But it does say, applauds the latest bank earnings. And there was a good retail number out this morning. People are still spending, but really, it does set the tone for banks, arguably one of the core features of the economy, to be able to make money in this environment, which means they're healthier, which they can turn around and lend and now, protect that economy, if you will. If the banks have to start not shutting down, but start reducing what they're able to do for folks, then that has a secondary effect on the economy. So overall, Allison, I think this was a great earnings beat for Citigroup. We'll pull up their ticker here. It's up now, 8% on the day. You back that out and put that in a little bit of a perspective. Well, yeah, they've been crushed, right? So 67 down to 45, jumping up, almost $4 a share this morning. When you look at these numbers, though, it's a screaming buy, right? 4% dividend yield. You got to like that no matter who you are. Current PE of 5, forward PE of 7. There's just so much to like here. The only thing not to like personally is I don't think they're best of breed. So I wouldn't invest in Citigroup unless it's a secondary investment, more of a value type investment. If you want the growth, I think still JP Morgan is your best of breed for in the space out there.
Thank you everyone for your questions. Please submit your questions as a comment through social media or directly to our email at vipservices@ankerstarwealth.com. And don't forget to like and subscribe to get daily updates. That's all we have for today's show. I'm Allison Ankerstar and we'll see you back here Monday.